When I was first raising money for my startup, I was totally overwhelmed by all the different terms that I had never heard before. Things like liquidation preference, term sheets, or share classes. And in some meetings, I even felt a bit too embarrassed to ask investors or lawyers what the different things meant. Back then, I read a ton of articles to learn and understand everything that I needed to know. And to save you that time today, I thought it would be cool to create a video on the most important fundraising terms you need to know. First up, runway. As a startup, your runway is how long you've got left before you run out of money. At each fundraising round, you need to collect enough money to fuel you to your next raise or ultimately profitability. And this is typically a constant cycle as you are raising several rounds of funding. So make sure you are raising early enough so you don't run out of cash if something goes wrong. 2. Term sheet. A term sheet is a document that describes the offer from your potential investor. Think of it as a summary of the most important terms like valuation, investment amount, but also things like what will be inside of your shareholder agreement, like tag-alongs or vesting. Always remember that a term sheet is a non-binding contract until the real contracts are signed. So you can take it as a lever to shop around and negotiate with other investors. 3. Burn rate. Most startups are not profitable from the start, and if you are raising money, it is most likely that you also fall into this category. The burn rate describes how much money you lose on a monthly basis. Just a quick example. Imagine your expenses are 40k per month and you are not generating any revenue. So your burn rate would be 40k per month. So let's say you want to hit the next milestone in 12 months. That means you need to raise at least 480k to cover your burn rate till then. 4. Due diligence. This is one of the most annoying parts of every fundraise. In order to go from a signed term sheet to the money in the bank, you have to endure the investor's due diligence, or short DD. In a DD, the investor digs into all of your company's details to verify that everything you told them is correct. As you can imagine, this is quite easy and straightforward for a company that is raising a pre-seed round and is only a year old. But imagine you are raising 50 million plus at a Series B or C. Obviously, the DD is way more complex then and also takes much more time. 5. Dilution. Every time you are raising money from investors through an equity round, you are giving away a portion of your company. So imagine you started as 2 founders with 50% of the shares each. Now you are raising 2 million at a 10 million post-money valuation. So you are giving away 20% of your shares to the investor and diluting yourself combined to 80%. As you can see, the dilution describes the decrease in your ownership of the company. 6. Post-money and pre-money. The pre-money valuation describes what your company is worth before an investor brings new cash to the table or to the company. So let's imagine your company is worth 6 million, or better to say you agreed on a 6 million valuation, because obviously you couldn't exit the business at the same amount. That's your pre-money valuation. A bunch of investors agreed to invest 3 million of fresh capital into your company. So we add 6 plus 3 and end up with a $9 million post-money valuation. With the post-money valuation, you can then calculate the ownership of the new investors. Just 3 divided by 9, so 33.3%. Number 7, board seats. Almost every company has a board of directors. That is a group of people that supervises the management and that participates in the big decisions. You can expect investors that are putting a big check into your company that they want to have a board seat. But be very careful about these, as they have a lot of power. They are like the CEO's boss and, for example, fire you. 8. Convertible Note and Safe Note. These are 2 special types of funding that start off as a loan but can convert to equity at a later time. These are especially common in the early stages of your company, as they are really quick to set up and you don't need to decide on your valuation right now. We are going to take a deep dive into convertibles and safe notes in another video. Number 9, cap table. The cap table is a breakdown of how much equity in a business is owned by which individual or entity. The cap table helps you to clarify the percentage of ownership before and after an investment round, as well as any dilution. And speaking of dilution, let's talk about number 10. the Anti-Dilution Protection. In most contracts, you will find a clause that will protect investors from diluting their ownership of the company in the case of a new investor coming in at a lower valuation than before. Quick example. Let's imagine you raised at a $10 million valuation for your seed round and brought an investor in that owns now 10% of the company. But things don't work as planned and now you need to raise new capital at, let's say, a $5 million valuation. Depending on the exact clause, the first investor wouldn't dilute now because you agreed on the anti-dilution protection. But you as a founder would dilute disproportionately. Number 11, liquidation preference. This is another common clause that will be found in almost all shareholder agreements. The liquidation preference clarifies which investors receive payment first if a company is liquidated or sold. In many cases, this is even the case before you as a founder will see a single dollar. Speaking from the investor perspective, it is a way to de-risk their investment. We'll be talking about liquidation preferences in another video more in detail. Number 12, drag-along and tag-along clauses. Another clause that I didn't know about when I took my first investor on board were the drag-along and tag-along clauses. For investors, but also shareholders in general, it is about being actionable as a company. And that's really, really important for them. Meaning, if a good opportunity comes to sell the company, you must be able to take it, despite minority shareholders not wanting to sell. But on the other hand, there needs to be some protection for them as well. That's why the drag-along right exists. It means that majority shareholders can force minorities to join in the sale of the company. Quick example. Together with the investors, you as founders own 75% of the company. You now get an offer for 100 million for the whole company. So we can just decide that we want to take the deal no matter the opinion of the remaining 25%. But obviously we have to make sure that they are getting the same price, terms and conditions. The balancing right is the tag-along clause. It makes sure that if a majority shareholder wants to sell his stake, the minority shareholders has the right to join in the transaction. Number 13, vesting. Investors are always investing in people, so they don't want you to leave the company right too soon. To make sure that this doesn't happen, vesting exists. It is a legal term that describes how you earn your shares back over time. To make a really simple example, let's imagine you own 48% of the shares of the company. Now the investor asks to create a vesting scheme for these shares that has a 4-year duration. That means you are earning 1% of your company's shares per month. If you leave after 1 year, you would only own 12%. The idea behind this is to protect the company and have enough stock to incentivize someone new to join if you happen to leave early. As a small side note, in most vesting clauses, you will also find a cliff of 1 year. That means if you leave the company in the first 12 months after getting the investment, you won't get any shares at all. So I hope you liked this first video on startup fundraising terms. We will do another one soon. Make sure to comment and subscribe and see you next week.